morning, Riaan. Thank you very much for your time. I really do appreciate. It's always nice catching up. It's our boardroom has changed quite significantly, and due to the fact that we're now communicating electronically, but it just shows you how effective the world has now become in during these uncertain times. So thank you very much for your personal time then allocated. So the purpose of this discussion today is really just to talk us through, if you don't mind, just unpacking the efficient private client value proposition. What are we looking at? How did COVID, first of all, affect our existing position? So what did we hold in terms of assets prior to us going into COVID? And have we considered any rebalancing or tilting in any way, post COVID and the waves following, the various rollouts that we've seen?
Yeah.
So if you wouldn't mind.
Yeah, so I think that for us as active managers and discretionary active managers, we like these sort of environments where we can add value to our clients' portfolios over the longer term. I think what's important is to be able to identify companies you want to own. I'm just going to take you through what we've been doing over the last quarter and what we see, how we see the markets unfolding going forward. I think a lot of clients and a lot of advisors sort of feel like this slide where there's a lot of uncertainty and it's very hard to make long-term decisions and to make shorter-term decisions when you are in the middle of all of this uncertainty. So what we are doing is really focusing on everything that's inside of our control. We have to focus on valuations. We can't overpay for growth stories. We have to focus on companies where we can really see this business is not only going to exist in the next 10 years, but really going to thrive in the next 10 years. I think that our money management philosophy and process is actually playing out very well into these times. What's important to us is that we have to construct a portfolio of the world's leading companies and the way we see the world. That means that we have to invest in companies where there's not necessarily the companies that's growing the fastest or the companies that's growing, that's becoming the biggest, but the companies that fulfill a very specific role within the portfolio and really add to those defensive and also qualitative and quality attributes of a portfolio that will keep the portfolio growing in the longer term. What's important for us at the end of the day is when we construct portfolios, we look at three things. The first is, does this company have a competitive advantage? I think the times we are in now, that becomes so clear. And there's a lot of examples in our portfolios playing out. I mean, we are seeing that guys would rather cancel their office leases than cancel their Office 365 subscriptions. And you can see that in the numbers coming out of Microsoft. You can see that in the way the share has been performing. So really, the defensiveness that we were used to in the 80s, 90s, and now, that sort of changed. Defensiveness now means annuity income streams. It means a scalable business model, and it means really owning your client and becoming and providing a best-in-class service. What's also important for us is just those structural growth drivers. The global middle class is going to continue growing. The way it's going to unfold is going to be different, but that's a structural growth driver we still see playing out. And also we are seeing this earnings progression where companies are involving and investing in themselves to make sure that they are able to keep their market share. I think a very good point, and to your question, is how are we positioned going into COVID-19? So in the healthcare space, we like focusing on thematic trends because we need to have an idea of where business is going and a bit. The companies we invest in, it's nice if they're almost forced to make more money. So in the healthcare space, we were really focusing on an aging population as well as growing lifestyle diseases. And these are companies that either they are drug originators, so they're not really that close to the regulatory burdens of generic drug companies and so on, and companies that focus on lifestyle diseases, for instance, outpatient care. More people get receives their care from home. Those are trends that were in play a long time ago, and that's really coming to a fore now. And throughout the portfolio and throughout the general sectors, what we're seeing is COVID-19 actually just accelerated a lot of what was already happening. People already were focusing on being cared for at home because it was, one, dangerous to go into hospitals. It's expensive. The people that typically who pays for your hospital care are medical aids and governments. That's a big cost burden for them as populations get older. So that was a trend already in place, and it was just accelerated by COVID-19. And we're seeing it in other places as well. What happened in the tech space is basically everything became or got merged into one sector called from home. We work from home, we play from home, we relax from home, and that's a trend we see that's going to continue. Our portfolios were positioned to take advantage from cloud computing because it was a growing trend that we liked, from the 5G revolution, from artificial intelligence, the voice-activated internet, and even online security becomes more important. And those were all sub-themes that we've identified and invested in and brought those revenue streams into our portfolios. But what's becoming sort of clear now is it's basically all one big mega theme, and that is from home. And I think the portfolios are very well positioned for that sort of general process. In the financial space, we thought interest rates were going to come down. The reason for that is because globally interest rates were falling. In the US, they were quite stable. That had to change. So the world was dragging US interest rates lower, and that would have had an impact on emerging markets as well. Globally, interest rates would come down. So our portfolios were positioned for companies that benefit from this. One of the biggest beneficiaries in the financial space is a credit rating agency. I'm going to talk on that now. But something else that we think that we're going to see going forward is actually increased savings rates. So what we saw typically after a big crash, and especially after the Great Depression of 1929, is savings rates went from basically nothing to in the mid-20s. And we are well positioned for that as well in the portfolios, owning companies like Amundi and building positions in other companies that would benefit from this structural rise in savings as well. Also, what typically happens is markets start to recover, and then you get that additional added benefit as well. These companies are also typically pay out very healthy dividend streams. So if we can lock in those dividend streams, if we can lock in those rising tides at these times, that makes a lot of sense in the portfolio management space. I also think what's important is in the consumer space, we've really been focusing on how entertainment was changing. And we got most of it right, but we got some of it wrong as well. We realized that as people urbanize and move into cities, our entertainment needs change. Gaming was always a big theme for us. We're playing that through companies like Sony, and we're also big into the e-commerce space for Amazon. That's a trend that I think we can expect to continue going forward. So that's quite important to us. But what really changed is the travel industry. And that's most likely one of the areas in the portfolios that's going to take longer to recover. And we've actually exited some travel exposure because of that. Because even the likes of Boeing and Airbus, their CEOs are saying that they expect 2019 levels or the industry to recover to 2019 levels by 2023. We really need a vaccine before the travel industry will become what it was before. So that's something where there's a lot of risk and what we're avoiding at the moment, but there might be opportunities going forward. In the industrial space, what we're focusing on is especially your companies that specialize in express, in other words, in delivery and so on. With COVID-19, the bigger, there's a lot of moats that's been created because the bigger players are going to continue getting bigger. They're well resourced. They can capitalize on these sort of environments, especially in Europe where there's a lot of regulatory protection as well. It makes a lot of sense. What was happening before COVID-19 is that we saw a rise in geopolitical risk, especially in the Middle East, especially as the US was starting to withdraw from the Middle East. So we still have decent exposure to the defense space, and that's something which I think we can continue to expect to see, especially with the pressure on the oil price. If governments are under pressure, they start making irrational decisions and tensions start to rise, and that's a space that we also think we're still going to see growth going forward. In the material space, we don't own that much. We are avoiding that space at this stage because we really just don't know how a recovery is going to look. And then utilities to us, they are starting to look attractive, but we're avoiding them for now. And there's just in terms of property, that's a space where international property we just don't find attractive. We'd far rather invest in these other sectors which are far more attractive to us. To give you some ideas of just news flow, what we've seen over the past couple of weeks, Amazon hired an additional 1,755,000 workers. The first 100,000 of that was to replenish existing staff and so on, and to bolster their workforce. But this new amount of people, the next wave of 75,000 warehouse workers that are hired, that's really for them to capitalize on increased demand. So we can expect Amazon to spend a lot. Their results are out later this week, and I think we'll see a lot of spending. But what we can also expect is them capitalizing on this structural growth driver. What we're seeing in tales out of Wuhan, for instance, is that companies really are, or rather consumers are really just not going back to malls. Malls are running at 50% occupancy and they are open. And even we're seeing trends similar to that in the rest of the world as well. Last week, we had the UK clothing retailer Next. They opened their website for the first time after the lockdown, and their website crashed within 2 hours because people are just buying online. They're not going into stores. Also, what we're doing is, I mentioned falling interest rates, and we want to benefit from those falling rates. What typically happens is when rates fall, we see companies issuing a lot more debt, one, to bolster their balance sheets, and two, because it's the cheapest it's ever been. So it makes sense to issue a lot of debt if you almost don't pay anything on it. And this is across the spectrum. This is companies from Oracle to Nike really issuing a lot of debt. Now, the companies that benefit from this are the credit rating agencies. In South Africa, we don't, they have a bit of a bad rap, but these companies actually provide an essential service into that space. Their pricing is very rigid. They have large moats, and there's basically two companies that dominate that space, S&P Global and Moody's, with S&P by far being the biggest one. So they are well placed as interest rates fall and as companies issue more debt to benefit from that. So we like this sort of space within the broader financial sector. I think investors should be careful to take positions in companies that need rising interest rates to make money. Banks, for instance, is something that I think we'll avoid, especially globally, for the foreseeable future. And then what we're also seeing is companies really using these falls in valuation to bolster their long-term earnings growth. So what's nice about being a portfolio manager is we can invest in companies where we really see these the underlying earnings growth of a company growing for the next 10 years. We like Sony. We've spoken about it before. Sony is one of the big entertainment companies. They specialize in sensors that goes into cameras. They specialize in the Sony PlayStation 5, which is going to do very well, especially after the lockdown. And they specialize in movies and music as well. And for them to bolster that entertainment ecosystem by investing in other companies makes a lot of sense. They bought into a company called Bilibili. You can sort of think of it as the Chinese YouTube. They started out with anime. They are moving into a lot of other areas, and they already have 130 million users. So what we're seeing is, if I take a step back, we're seeing that there's still a lot of companies that actually make more money because of what's happening globally, and also they're using these lower valuations to buy other companies that might be in trouble or that can add value to their longer term businesses. And I think that's what's important for us to see. So yeah, that's just a quick overview of what we've been doing.
Riaan, given the current levels, I often get asked, when you perceive to be at the bottom of global market turmoil, the old long debate in terms of passive versus active. Buying ETFs at this level, when you're expecting to be at the bottom, does that not make sense? I mean, I know from a cost perspective, a lot of clients are very sensitive. Is that not something to consider?
Yeah, so we like people buying ETFs because they also sell them when they get scared, and that's why we got the opportunity to invest in a company like Johnson & Johnson at a price where it should never have been trading at, but mass selling of these exchange traded products forced the share price down, and we were able to use that to our advantage. So yes, definitely passive has a place, but for us in this environment, there's very clearly going to be winners and very clearly going to be losers, and you need to be able to identify those and invest in those. I think that when there's a rising tide, for instance, when there's these massive global stimulus packages, or when globally interest rates start to really fall, it makes sense to invest in these companies that benefit from everything. But when you have these few winners and a lot of losers, I would rather just want to own the winners, especially in the times we are in now.
Good point. And in terms of our local markets, I mean, we now briefly touched on your views on from a global perspective. Local markets, I mean, we have not seen the peak of this. We're not sure, what this would look like. COVID-19, I said the other day to some of our other colleagues that, COVID's not going to pack up its bags and go. We're not sure what it looks like when we walk onto the streets again. Would you be able to elaborate on some of the local companies that you identify opportunities in? I mean, obviously a larger quality tilt once again, I assume.
Definitely, yeah.
But there are companies in South Africa that would be able to withstand what's happening here and make it through this. And
Definitely.
certainly there must be some certain opportunities.
Yeah, I think what we're doing in local portfolios is we're basically avoiding the big two L's, and that's leverage and load shedding. If we look at what the companies on the ground are saying, load shedding returning after the lockdown, that's a big risk for a lot of companies. We hear a lot of management teams commenting on that. For a lot of your companies, it's their busy season, especially your pharmaceutical, your pharmacies and so on. So I think that's the two big risks: is one, being over leveraged, so there's too much debt on your balance sheet, and also the risk of load shedding. And load shedding risk plays through different businesses differently. There's a lot of obvious companies that struggle. Those are some of your manufacturers and so on. But even a company like Tiger Brands, when their plants are down and when their ovens are down, it takes a half a day for them to recover in some cases. So it really impacts their ability to manufacture product. Where if you're a food retailer, there is demand for your product. You can switch on a generator, so it's going to cost you a little bit more, but you don't lose half a day's worth of production, if you want to call it that, half a day's worth of sales, should you experience load shedding. So those are some of the companies we focus on. In terms of the broader sectors, in the industrial sector, we really like the Bidvest and so on of the world, where their balance sheets are solid, and that's something that we see throughout the local space, especially as balance sheets really are important. The advantage for us is that most South African companies aren't that over levered. There's basically 4 companies with a lot of debt on their balance sheets. That's Sasol, Anheuser-Busch, MTN and Aspen. For the rest of our bigger blue chip companies, they actually don't have that much debt, so that's a positive. And also there's companies that are going to go bust in this space, so some of their peers might be able to take advantage of that. We'll have to wait and see what happens with Edcon, but should Edcon not reopen, that would be an advantage for a company like Mr. Price, for instance. So we'll see how that plays out. I think there's a lot of uncertainty still. I think in the retail space, it makes a lot more sense to focus on your food retailers. I think there's 1 or 2 apparel retailers that make sense, but we focus on those. In your financial space in South Africa, banking is different to the rest of the world, because now we're focusing on, are the banks going to survive this or not? Our view is that they're very well capitalized. And also once their dividends resume, we will pick up a lot of attractive dividend yields as well. So some of our SA banks look attractive to us. Some of the SA insurers that are actually growing market share, they're attractive. And especially in our mining space, we're also finding opportunities. So in the JSE, there really is still opportunities for us, but I also, once again, think you have to be selective.
Look, you mentioned the asset called Sasol, and my phone has been ringing off the hook. To determine from clients wanting to know whether it's an attractive asset. My view is that Sasol has not changed in terms of their debt levels. Nothing has changed. I mean, they're looking for opportunity or partner in the US project, like Charles project and so forth. But I mean, so what moves Sasol? Sasol had an issue prior to the oil price pulling back, which brought them from just above 600 to quarter 200 and so forth. What's your view on Sasol? In my view, nothing's changed. I mean, is it an attractive buy or not?
I agree. So Sasol, in context, they built an ethane cracker in America. It cost them about $13 billion. That's a lot of money. At the moment, they have approximately, and depends on the exchange rates and so on, but they have approximately $10 billion of debt on their balance sheet. They want to bring that down to about $4 billion. That means there's a $6 billion gap that they have to fill. There's a few ways they can do that. They can optimize some of their operations. They can postpone a lot of the capex that they want to do. That will get them approximately $2 billion. Then there's a $4 billion that they still need to cover. It all depends on asset sales. If they're able to divest some of their assets, it might make sense in this environment. If they can't, then they have to come to the market and do a rights issue. Now, it's not a very attractive market to sell assets in at the moment. The oil price is depressed for the reasons we all know. Emerging market currencies are under pressure. The global consumer is under pressure. So it's going to be interesting to see if they can do the asset sales at the prices that they want. So as Sasol is very geared, approximately 15% of its value is its equity, and the rest is debt. So that's why it moves in these big jumps, depending on what the oil price does and what the rand does. So in the shorter term, it's going to be a rand oil price play, but longer term, I just don't know if they'll be able to sell the assets required, and if they can't, that means they have to come to the market and issue equity. And the amount of equity they have to issue, we don't know. It looks like it can be anything between, well, basically $0 and $2 billion. So it can be very dilutive to investors. And that's the decision you have to make. So if your view is that the oil price will recover to $50 a barrel and the rand will recover a little bit, not too much, that is positive for Sasol, but it really depends on these asset sales at this stage.
Well, the only lucrative asset they have to sell, in my view, is Secunda. I mean, so,
Yeah.
And that's the only money generating asset that they own at this stage. Is that not so?
Exactly. Oh, it's by far the cash cow of Sasol at this stage is their Secunda operations. So definitely, and if something happens there, it will be interesting to see what happens to the share price in terms of cash flow generation.
Yeah, interesting times.
Mm-hmm.
Riaan, thank you so much for your time once again. It's always fantastic talking to you and getting your insight into the portfolios. I really do appreciate, and I'm sure our clients would also appreciate this input. So thank you for your time, and I'll catch up with you soon.
Thanks, Luciano. Thanks for your time.